We're going to put it back on automatic. So the program says, "Ooh, we're not making that mistake." It goes back to the 7.7 years, goes back to $179,000 in interest saved. Now, when I show you this, it's going to make perfect sense. Okay. You're going to say, why isn't anybody talking about this? Why is everybody talking about the debt snowball? Why is everybody following the guy in Tennessee and says, do the debt snowball? Watch what happens when we do this. Okay. I need you to see what's going on here, because the guy in Tennessee says, focus on the car loan next. All right. So when I hit the car loan and look over here to the left, I hope you guys can see this. Maybe I can make it a little bit bigger. All right. What are the interest payments on the car loan? When you can see this, I need you to look over to the left, hit your mic. Come on, tell us, what are the interest?
$83.23.
Actually, $83.33. All right. And the principal payments are $377.08. So we have to come up with $377.08 to eliminate $83.33 worth of interest, correct?
Correct.
But will it feel so good to pay off that car loan and be done with it in 2 years? But while we're doing that, all of our focus is on the car loan, killing $80 interest payments, correct?
Correct.
So, but if we go back here and take a look at everything in the accounts, so that means if we're focusing on the car loan, that means we're just ignoring the mortgage and making minimum payments on the mortgage, correct?
That would be correct.
Well, let's take a look at this. How much interest are we paying on the mortgage?
$1,000.
How much money would we have to come up with to eliminate $1,000 worth of interest?
$199.10.
So answer me this. Does it make sense to focus on the car loan, even though we're going to pay it off early? Focus on the car loan that's only costing us $80 interest payments, and just forget about this mortgage that's costing us $1,000 or $900 a month for the next 2 years just to pay off the car.
No, it takes a special person to think that.
Okay, then why are we being taught that by the guy in Tennessee? Pay off the car first, then focus on the mortgage last. That's baby step number 6. The mortgage is last. And every single month, you're giving the bank all of this money just so that we can follow a program. And I asked this question in my book. By paying off the loan, you feel good. You feel good about paying off the mortgage. My question is, how much do you want to pay for your good feelings?
Hey, Don,
yes.
Can I add something?
Come on.
I just want to add, the guy in Tennessee does not believe in permanent life insurance, only term insurance. So many people listen to him for his advice, and he's not a licensed agent, and he gives general information and not consultative, personalized advice like you're doing when you do the P.I.L.L method. Just want to add that. My name is Troy, and I'm done speaking.
Troy, let me tell you my own personal story for listening to that advice. I will admit, before I knew anything about all of this, I listened to that advice. I was married in 2001. Okay. And when we got married, we got 20-year level term, 20-year level term. So, Troy, what is the percentage of term policies that actually pay out?
98%.
Term policies that don't pay out is 98%. The ones that do pay out, that's the question I asked. What's the percentage of term policies that do pay?
2%.
2%. Now, here's what happened to me, folks. So I got my policy in 2001. All right. So has my 20 years expired, Troy?
Expired last year.
Did I outlive my policy?
You sure did.
Out of all that money I paid in, what happened to that money?
It's gone.
Okay. Now, can I add a little bit extra to the story?
Yep.
I got diagnosed with cancer. I am now a cancer survivor. Praise the Lord. How difficult is it for me to get insurance now?
Very difficult. And if you get it, you're going to pay more if they decide if they want to insure you. And you're going to pay a lot more, significant more. And they also may put a stipulation in the policy. We will insure you, but if cancer come back, it may not be covered.
You see what I'm talking about, folks? If I had gotten a permanent policy, Troy, would I still be covered now?
Yes, as long as you made the payments, you would still be covered.
Come on, man. This is what we're talking about, folks. Stop listening to folks that have a TV program or a television program that doesn't have your best interest at heart. We're giving you the sauce over here, as Luis would say. You're getting the real sauce over here. Okay. So what we're trying to tell you is I've made some mistakes. I learned from the mistakes, but now I'm going to teach you what to do so you don't fall victim to the same information. Do you know, if I'm following the guy in Tennessee, do you know we have people out there that will try to get a house, but because they paid cash for everything, they thought that was the way to go? And you know what? The only thing worse than bad credit is no credit. That's the only thing worse than bad credit, no credit. And if they can get it at all, it costs them through the nose. So folks, watch out who you listen to. Watch out what's going on here. And we're going to give you the receipts. We're going to show you the numbers behind what it is that we do. So here's what we're doing, man. Sinistra. So do you see why it's important to pick the right loan at the right time?
I have never seen any program. I've seen a lot of programs that are this robust.
Well, you know, we're just getting started now, because when we show people, when we go into net worth here, all right, and then when you pay off that mortgage, this is what we're talking about. So John and Rebecca Jones, and we're going to show them that they are going to be, their payoff date is in 2029. They're supposed to be paid off in 2052. All right. So if we go down here and click on wealth accumulation, they're going to be out of debt early. Okay. What if they take the money, they're no longer paying on the mortgage because they're done, and then calculate their interest savings. And then we focus in on putting that money away because they were paying that money and now they're not. What if they were to take that money and put it on some type of investment until 2052? Let's go down to 2052. Look at this. I wonder if anybody can tell me, by the time most people are paying off that mortgage and they take that money and put it in some sort of investment, this is at 1% return on their money, Sinistra. How much money will they have in the bank when other people are just trying to pay off their mortgage by 2052?
Just a little south of $1 million.
Come on now. Now that's at 1% return. Troy, what was on the average policy that is a permanent policy? What are you guys paying historically over this period of time?
Right now, conservative, we are running proposals about 6%.
6%. This is well over $1 million. This is over $2 million or more. Come on. This is what we're talking about, folks. It's bad enough that we're paying more interest than we need to. But what's worse is the money that money will never make for you. This is what we're talking about. This is what we give every client. We not only tell them how much interest you're going to save, but we'll tell them what your earnings could be over the same amount of time at only a 1% return on your money, almost $900,000 here, which is, when we run it at 6%, is amazing money. Amazing money. That money that's formerly going to the bank that they're going to invest, now you can invest it.
But Don has some valuable information that can contribute to the quality of a person's life. And it only costs you a few dollars. It's his book. Why not get that?
I'm going to go through the P.I.L. method myself with some of my investment properties. So I'm going to link up with Don, and then I'm going to sit down with him, show him my investment portfolio, and see how I can eliminate interest.